Hello, I'm Steve Balch, the Director of Wealth Management and Financial Planning at Certa Financial Planning, here to give you our monthly market update for November. Our macro stances have stayed status quo for this month. The market saw a small negative return in October, but the overall trend remains positive as 8 of the 10 months have seen green. The Fed policy continues to be positive as they cut rates another 25 basis points at the November meeting. Expectations of further cuts have dampened, but another 25 basis points is expected in December. Fiscal policy remains positive as there appears to be no end in sight to our current spending binge. This remains a net benefit for the economy and markets in the short term. Leading economic indicators remain neutral but contradictory. After September's blowout jobs report, October's jobs report was a major miss. Overall, the data is softening, but wages continue to be strong and GDP is growing. Valuations continue to be neutral, but a positive sign for a longer bull market run is the widening net of rallying asset classes and markets. The market regime has moved back to a reflationary regime. This still provides us with a risk-on environment, but does occur when inflation is rising and economic growth continues to be positive. The business cycle continues to be mixed. The U.S. economy is showing signs of both mid and late cycle action. Recession risk in the near term continues to be muted as real wage gains remain positive. The labor market is softening, but the total job openings to unemployed workers remains high. Here are the 3 questions we're monitoring. What does the election outcome mean for the markets? Why are rates rising again? How long can the bull market last? The election is over, and as of this video, the Republicans will have control of the presidency and the Senate. The House has not yet been finalized, but the GOP is projected to control that as well, making it a clean sweep. Historically speaking, a split government is better for the markets than a one-party sweep, but both outcomes are positive. Additionally, the first year of the presidential cycle tends to be positive, as the prospect of the candidates' proposals getting accomplished act as a tailwind. Typically, year 2 is when reality sets in and the market tends to have more muted returns. For now, the market is reacting positively and the uptrend continues. Why are rates rising again? The Fed ended its tightening policy in September with a 50 basis point cut and continued that trend with a 25 basis point cut in November. The Fed is expected to cut another 25 basis points this year in December. However, even with a large cut in September and the additional cuts expected, the longer end of the curve has rallied over the past 2 months. Part of this is a positive response to economic data showing recessionary risk continue to be kicked down the road. Another part is a negative response to potentially more spending, potentially higher deficits, and inflationary concerns. The reality is the market is responding well to the current election results and hopeful for continued economic growth. However, if the longer end yields continue to stay elevated, the market may soon realize the negative impact higher yields have on economic growth, particularly the housing sector. This may cause some stock market volatility. The rising longer end of the yield curve could be a headwind to watch for 2025. How long can the bull market last? Believe it or not, but the bull market turned 2 years old last month. Going back 50 years, if a bull market makes it past its 2nd birthday, that typically has been a positive sign for more years to come. If a bull market gets past the 2-year mark, the average length of those bull markets has been 8 years, with an average total return of an average total gain of 288%. The current bull market is just up over 60%. No one knows what is in store, but history tells us this bull market may just be getting started. Our positioning and outlook. 2024 continues to be a strong year for the markets, and history tells us the trend should continue. When the S&P 500 is up more than 17.5% year to date going to November, like it is this year, the market has been higher in November 12 of 14 times, and up in December 11 of 14 times. The market has never been lower the final 2 months of the year when we've been this strong heading into November. Additionally, November is historically the best month of the year and has started this year very strong. Last year, November was up 4.1%, and in 2020, we were up 7.4%. For now, we continue to stay the course and see the market finishing strong for the year. We do see inflation as a potential issue that may cause us to shift more into commodities, but overall, the risk on environment continues. We thank you for watching. As always, please feel free to forward this to anyone you believe can benefit from the information. If you have any questions, please feel free to reach out. Thank you and have a wonderful Thanksgiving.